Welcome to TheoTRADE. This is Don Kaufman. October 20th, 2023. Just moments to go to the cash close here on this Friday afternoon. S&Ps and, well, the entire marketplace absolutely rocking with volatility throughout the course of this week. Look, we're in the midst right now of some market mayhem. Bonds, they're down. I mean, the bonds have just outright crashed. Geopolitical risks are flying higher. Let's get right to work here on this weekend update. One of the first things that I want to state here as I start to kind of dig into the markets to some degree, it's not about so much like, all right, look at the chart here. This is where the S&Ps are. Look, people, you're in the midst, okay, of a geopolitical hotbed of risk. To compound all of that, I mean, the bonds, which, all right, they had kind of a mellow day today. I'll give you that. They've just outright crashed. It is horrendous. And I've talked about this incessantly, and I'm going to dig into it more because the implications moving forward from what's going on in the bond market is far more reaching right now than some of the present geopolitical risk. And that, people, is a huge statement to make in this marketplace with, again, weekend volatility is just up there. It's rocking. And again, we're going to cover that here momentarily. But this is all about implications moving forward. Like, you look at the bonds all you want. Great, they crashed. Where to now? What are the implications of the bond market crashing? What are the implications of the S&Ps? I mean, down huge over the last, 3 trading sessions. But this is where things are going to get very interesting. Okay, let's get started here discussing, as I said, it's a little bit of market mayhem. Bonds down, geopolitical risk is up. One of the first bullets that I have here on the weekend update. So bonds have crashed, and that's, again, not an easy statement to make, but you are effectively at this point, let's bring up like the last 3 years. I mean, we're 3 years into what has been a horrendous bond market, but the most recent sell-side activity that we're seeing in here is nothing less than absolutely stupendous. Now, any way you want to shape this up, like, look, you can look at the bond market and you can look at what we term auto-expected moves. And auto-expected moves basically is showing you what this marketplace, in this case, obviously the bonds, and what this marketplace is showing is how wild the movement is regarding options outside of what was expected. In this particular case, again, I'm looking at ZB, and I'm going to switch it up in just a moment here to TLT. But as I'm showing you the implications, like it's just 1 week smashing the expected move and smashing expected move. And when you smash through an expected move, okay, you're basically saying, all right, expected move is 68.3% of the time. The end of the week, we're supposed to be in this range. Okay, smashing through it, you're like, yeah, whatever. But when you start looking at the bond market and it breaches 3 weeks to the downside in a row, then breaches to the upside, then has another, like this week, it's over 2 sigmas to the downside. It's statistically like breaking apart. It's become, if you will, Mr. Toad's wild ride inside of the bond market. And maybe the cleaner way to look at it, as I said a moment ago, is inside, if you will, TLT. TLT is like the ETF version of this. And inside of the TLT, like, again, it's 1 breach, it's 2 breaches, I mean 3, okay, breach to the upside, huge, okay, just unruly move inside of the bonds to the downside throughout the course of this week. What are the implications of it? Of course, everybody points out like, well, look at the interest rates, and the interest rates are, look, they came just within a like hair off of 5%. Yeah, that's probably going to happen and then some at this point. But I'll be frank in saying the implications of interest rates soaring like this, and the only way to describe that, that's an absolutely parabolic move in the 10-year. That's 10-year interest rate hitting, again, just shy of 5%. The implications of higher rates, that's not going to be felt now. It's going to be felt down the road. That can actually induce maybe a little bit of fear. But that right now, okay, isn't my cause for concern. My cause for concern is the implications of what we term unrealized losses, okay? And unrealized losses, banks are taking billions and billions of unrealized losses. Like how many banks own this 30-year. You realize if a bank actually bought the 30-year at any point in the last 9 months, okay, how substantial the decline happens to be. Why don't we put a number to that on a year-to-date basis? Year-to-date basis, bonds are down almost 15%. That's on a year-to-date. You want to look back over to like the last year, okay? It's ugly. It's hideous out there. You want to look back over the last 3 years, okay? Over the last 3 years, they've actually basically lost, well, what, almost 37%, okay, of principal. But of course, everybody says, don't worry. If we hold it to maturity, what's going to be left in maturity? Are we going to make it to maturity? That's the kind of questions. At what point are these banks and some investors, and we're talking big institutions, you start to panic out of this? And one of the things I'm looking for inside of the bond market right now is just that, because the implications, are not just far-reaching; they're everything. It's the global economy. Global economy can literally collapse overnight with a large and precipitous sell-off. And the problem that I have in the bond market right now is we haven't seen that. I'm just not sure we've seen the capitulation that we need to see in this marketplace. And that's why I'm saying, okay, bonds at this point, they've crashed. And we just maybe haven't seen, though, possibly the bottom of it. Well, we're a lot closer now. And it might take rhetoric from even the Fed stepping in to save this marketplace before it's over. And I want everybody to think about that, because to me, the implications are horrendously bearish for the S&Ps in the near term. Something I'm going to talk about towards the end of this, everything right now, you got to think about risk reward. Is there upside potential in the marketplace? When I'm talking about the S&Ps, unequivocally, of course there's upside in the marketplace. But where the bonds are presently trading, downside risks are phenomenal to the equity marketplace, because the cost of borrowing is completely out of control at this point. Anybody that has to roll any debt over, which is going to be everybody here sooner or later, is going to be doing that at absolutely egregious levels. There's the closing bell. Okay, it's over, people. It's all over. But the bond market, do not take this lightly. This is a marketplace that you may not look at. You need to look at. You need to look at it at this point, because sell-side activity starts to persist in here, and I'm telling you. Okay, we're not talking about raising interest rates. We're not even going to look at that. Okay, forget about inflation. It's getting out of control. And I don't think that we've actually seen what the implications of out of control actually mean just yet. But the last 4 trading sessions in here, it's too methodical. It's just too easy. Okay, and moreover, I think we all looking at the equity market this week, and we're like, oh my, the equity market. Okay, except not enough people are talking about the fact that bond volatility, specifically to TLT, let's look at TLT for a second. The volatility 30 days out is still higher inside of the bond market than it is inside the S&P 500. And people, that's not good. It's just not good. And again, say what you will about a marketplace, and you can get as bullish as you want on me until we see a bond, not just recovery. Okay, I don't care if we recover in bonds, they're going to come right back to the table and they're going to sell them again. And that's the problem that we've got over here, is that every time these bonds want to make a bounce, okay, they're being sold into. So there's a couple of implications over here. If you do see the bonds rally massively, okay, that may also be incredibly bearish for the S&P. So again, hold that thought. Bonds are going to be everything moving forward. Okay, people involved in equity markets, they're just not talking about them enough, because it's probably lack of understanding. Again, the mayhem is really the bond market. Now, with that, obviously geopolitical risks are elevated, and every weekend right now, as long as there's geopolitical risk. And by the way, geopolitical risk. Okay, look, we can talk about umpteen different aspects, from the Middle East to Ukraine to Russia to, Speaker of the House. Look, it's all geopolitical risk. It's not pleasant out there. Okay, just wait. We're only a few weeks away from the government shutting down. Oh yeah, that's going to happen. It's too much to even try to grab your arms around. At this point, as I was saying a moment ago, everything has to be about risk reward. It has to be about capital preservation to a degree. Let's not get crazy, and look, I sold some premium today. Why did I sell premium? I nibbled. Okay, I shouldn't have, but I did. No, I nibbled on some premium because we hit the lower edge of the expected move and then some. But we hit the lower edge of the expected move. I sold some premium, but I got to tell you right now, it's edgy out there. Okay. Could the marketplace rally back up on Monday? Of course. But, always in the back of your mind, you need to be thinking about risk, reward, and capital preservation, which, every bullet that I've got this weekend, bonds have crashed, capital preservation. Bonds have crashed, risk, reward. Vol is elevated, but is it high enough? Risk, reward, capital preservation. Tech. Holy smoke, tech is getting dangerous right now. And we're coming into earnings. If anybody says anything negative, it is over, people, and you need to recognize that. So looking forward is everything at this point. I don't care, like, oh, look, we had a good trading day. Doesn't make a difference, okay? Markets, markets don't tank from highs. They tank from oversold conditions. And this last 3 days, it's rough. It's rough going out there. And, of course, people are going to talk about, well, at the 42, 45 level, there's a degree of support. There's no support, okay, in a bond market that's crashed and geopolitical risks bleeding through with, some of your biggest tech stocks on the dance floor for earnings. I'm sorry. There's just no support. There's no resistance, okay? You can disagree with it all you want, okay? But you don't know volatility until it gets unleashed upon you. All right, so the next bullet here, vol is elevated, but is it high enough? And when anybody and everybody talks about volatility, of course, I look at VIX. Is VIX going to go deep enough? Well, I'm going to discuss that right here, right now. It's an irony because the S&Ps are down like 1.3% today, and yet VIX, where is it? Massively unchanged. It was already pricing in a lot of the geo risk throughout the course of the week. One of the things I was pointing out on Wednesday night's video is you have this, a kind of a parabolic move to the upside inside of volatility. VIX is closing above 20 for the first time in quite some time. In fact, let's zoom out for just a second. We're going to zoom out, take a look at that. The last time you had volatility at these levels, like closing at these levels, you really have to come all the way back, all right, to the little market, the mayhem back in March, which was a bit of a banking crisis there. But look, with all due respect, the one thing I want to show you over here is vol is elevated, but is it high enough? And the reason that I'm very concerned at this point is look where markets came from. I mean, markets were trading, okay, under 4,000 the last time volatility was rocking like it is. Right now, I mean, people, look, we're at, 42, 45. And that's why I said earlier, in the video, I say, yeah, it doesn't matter about support and resistance. I don't really care where you have levels. Because quite frankly, look, vol could really get rocking over here. It already technically is rocking. And that's one of the things that people are not calling into question enough, is that all of a sudden volatility comes up. Pay careful attention, because volatility should be taken very seriously at a point in time where you have VVIX, okay? VVIX, the volatility index is absolutely rocking, which implies, okay, that VIX could just erupt in an instant. And that's why I was saying, like, vol's elevated, and I get it. And it is. It's a high VIX, and you should take it very seriously. But is it high enough? According to VVIX, things could get actually really, really hectic inside of VIX in the hurry. And that's one of the things, again, to kind of focus on. It's one of the reasons that I think the overarching theme of this update here is that, look, okay, you got a very serious volatility situation that most people are just not taking into account, all right, that the S&Ps, they haven't really sold off that much yet with volatility this elevated. So volatility is screaming like, risk is coming, it's coming. It doesn't really know if it's coming. And that's why I keep saying implication is to everything is risk reward right now. Everything has to be capital preservation. You can go out, you can definitely sell premium, and we're going to sell premium, and I did sell premium today, but you got to do it right now, kind of soft, gentle, let those trades kind of come to you, because I'm going to tell you right now, right, this is all hands on deck, right? And it's, again, it can get serious in a hurry. Remind you that markets, again, they don't tank from highs. They tank from, like, markets that look like this is where we go. And not only volatility, but the implications of those bonds, right? I mean, we've got both staring us right down the face. And again, I'm sure that everybody could pile on and point out 50 different risks that are in this marketplace, but it comes down to the bonds and it comes down to geopolitical risk. That's it. I mean, that's what it's about right now. Now, to further that over there, so vol is elevated, but is it high enough? Okay, quite simply put, yeah, no, this thing could actually go parabolic on us. Be very, very careful right now. To further that, also, if you take a look at the volatility futures closed in a very mild backwardation. Volatility futures, that is no versus D's, closed in a very mild backwardation, which implies that there's actually more risk now in the next 26 days than there is 61 days out. And that really resonates with me right there, is that the implications of risk, it's like it's right here, it's right on top of us, is where the risk presently is in this marketplace. All right, so something I was mentioning last weekend's update, something I mentioned on the Wednesday night video I did, and something I'm going to further right now, tech, okay? So if you took a quick glance at markets overall, okay, like QQQ, and we applied auto expected moves. Auto expected moves, as I said, and I started with this in the bond market, kind of handicaps risk, right? And when it comes to auto expected move, we broke pretty significantly today to the downside in Nasdaq. Now, how does that compare to other major sectors? Let's cruise around. The only sectors in my mind that are really in play right now, you got to look at energy. Look, energy, wow, did that get squirrely? I actually hit the upper edge of the expected move, pulled back over here. But energy is, trapped by geopolitical risk. There's no question about it. So you almost have to exclude it right now from that conversation. The other one is going to be financials. Financials, yeah, they got decimated as well. The financials, just when I'm like, oh, these things can't possibly get hit anymore, they're getting decimated as well. But for the first time, okay, in a very long time, when you start looking at the QQQ, yeah, pay careful attention, because when was the last time that you've seen a significant breach to the downside of the Nasdaq? All right, I'm waiting for it, because on here, okay, that was a brief and fleeting moment right there. There are very few significant breaches to the downside in the Nasdaq. You can't say that about the S&Ps. You can't say that about most of the other sectors out there. So for the first time, we're starting to see real risk start to bleed through in individual equity products. Now, your focus needs to be stuff like Microsoft. Why? Okay. Almost completely unscathed earnings. We're right on the dance floor for it. So here come earnings from Microsoft. You're taking a look at stuff like Apple. Look, I'll give you this. Apple's earnings are further out. Apple has taken some degree of a hit. Then we actually cruise on to Amazon. Amazon is taking some degree of a hit. Amazon will actually have earnings this next week. The only point that I'm trying to make, look at products like Google. It is unscathed. And I've used that term for months right now. Every time we look like we're going to sell off, they're unscathed. They're unscathed. They may not make it through this next week unscathed. That's the point, because when everybody starts talking about support and resistance in the S&Ps, okay, they should start looking at stocks like Google. They should definitely start looking at stocks like Meta. They're at highs of the year, okay? Wake up. They're at highs, right? You got to open up like 3-year charts to see Meta higher than this. Look at Google. These things are smoking hot still. They haven't begun to come off in this marketplace. And again, that's why I say tech is so dangerous. And of course, one of these is going to have spectacular earnings. We hit it out of the park, okay? They might hit it out of the park, but it's going to be forward looking. Everybody wants to hear. They could say, we hit it out of the park this quarter, but moving forward, okay, we need to curtail estimates. Things like NVIDIA, ooh, that got hit a little bit this week, talking about tech. But overall, like NVIDIA, let's kind of put our money where our mouth is. That thing hasn't been hit yet. And it's one of the reasons I'm actually short still in NVIDIA. Anyway, again, tech, it's really dangerous out there. So tech, if anything, at this point, when you think about like risk reward, okay, it's not a pleasant story. It's just not a pleasant story, because risk is very apparent to the downside. You'd have bonds have crashed, geopolitical risk, even if the geopolitics, okay, everybody gets along, we're all high-fiving each other by next week, it's not going to matter. The bond markets have already gripped hold. Interest rates are already higher. Those implications, okay, they're out there already. The bond market is just, it's going to really resonate in the days to come. And that, okay, is going to be one of the biggest risks for this market. That's why I say it's just market mayhem. Okay, gauge your risk moving forward, capital preservation, execute only, all right, when you really want to sell premium at the most opportunistic portions. When's the most opportunistic portions? Like, look, we cracked outside of the SPX expected move. Now, I remind everybody, there was a $90, again, a $90 expected move in the week of trade that we just passed through. So for the most part, you have this $90 expected move, right? What happened? We rallied, we fell flat on our face. We actually broke the lower edge of the expected move. But the entire trading session today came down to the lower edge of this expected move. Look at this. Yesterday, that was unchanged on the week, okay? Oh, what a difference a couple hours can make. This is 90 points lower. All we did is skirt the lower edge of the expected move and broke off of it towards the end of the trading session. We missed, okay, the lower edge of the expected move. But again, talk about like accuracy in trading, it's right there. As I said, the most important thing, what are we looking at moving forward? All right, so we just came off this $90 expected move. Ladies and gentlemen, yeah, we're looking at almost a $94 expected move. So risk is actually higher even after the proverbial crap fest of a week that we just came out of. Risk is actually amped up even higher. But a question again, is that going to be high enough? Look, all right, things to think about in this next week of trade. Geopolitical shocks. You got the market basically closed on Saturday and Sunday. There can be some geopolitical shocks that hit the marketplace, obviously, on Monday. Okay, you don't have to take my word for it. Look at the October 23rd. Okay, we have almost a $43 expected move, which is crazy over a weekend. Like coming into Monday, you know, guns a-blazing. Like, look, $43 move is some big boy risk. That was the same, you know, expected move that we had today, and the S&Ps ended up down 60. So geopolitical shocks, got to be concerned about them. The other thing, okay, bond markets. I can make arguments that bonds, they continue to sell off, okay? It's going to be full-on panic at the disco. But I can also make a very definitive argument. You got to be careful if the bond market really starts to rally. If the bond market really started to rip back to the upside, it would probably mean, okay, that trade was ducking out of tech like it was going like out of style. Like tech is on fire. They could come rushing back into the bond market, which should have equally as negative implications. Look, there's no easy way out of this. The only way out is going right through. People, market mayhem, bonds down, geopolitical risks up. That's it for this weekend update. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.